It's time for another Mortgage Minute with Frank Napolitano from Mortgage Brokers Ottawa. He'll answer some frequently asked questions about home financing and the housing market. And we want to remind you that the Mortgage Minute is for information purposes only. And you should always speak with your mortgage broker before making any big financial decisions. So, Frank, welcome. We got some questions for you.
Great.
All right, let's get to the first one. We are looking at buying our first home, and the MLS listing indicates that they have an assumable mortgage at 2.59% for another 3 years. Are there any risks in going this route? Does it sound too good to be true, Frank?
Boy, this is back in the 80s. This used to be very common, and again, shows my age, but now they seem to be back only because the interest rates have changed so dramatically over the last 16, 18 months that is a nice way to maybe get into the housing market. All of a sudden, instead of being at the 5s and the 6s like they are right now, you can get at 2.59. You still have to qualify for the mortgage, so definitely most mortgages are assumable. There's actually a risk to the existing mortgage holder. The way the laws are written right now, and they've never been updated, is that even though you assume the mortgage, the actual person who has the original mortgage right up until renewal date could be held liable. So there's not a lot of vendors that are making that option available, but the benefit to the vendors is that they don't have to pay the penalty to break the mortgage, because if somebody assumes it from them, then they also don't have to pay the penalty, which shouldn't be that much anyway based on where rates are. But not bad. I mean, is there a risk to the purchaser? Of course not, because you're getting in at 2.59 for the next 3 years. Now, the mortgage amounts have to match, and if they don't match, then the lender, assuming the lender, again, allows it to happen, then they have to blend the rates. So if you're borrowing an additional $200,000, you'd have to borrow the additional $200,000 at today's rate, and then whatever's owing at that rate, and they would blend the two rates. But you should still be ahead, so definitely worth looking at.
Okay. Second question. We got carried away in 2021 and leased an expensive vehicle and purchased another one. And with everything going up in cost, we're struggling to make ends meet. We inquired about ending the car agreements, but it would cost us too much. Our mortgage renews next year as well. And with higher rates, we are afraid that we may have to sell our house that we've owned for 15 years. Any suggestions? That would be appreciated.
Boy, I hope, and you know, we've seen a lot of this now where people overextended themselves in 2021, 2020, assuming that interest rates would remain low for a very long time, and they were safe in their jobs, and that the cost of groceries wouldn't go up as much as they have, and all of a sudden now they're really squeezed tight. So, you know, the fact that they've owned their home for 15 years, I'd like to think that they've built up a lot of equity in their home. So there's an opportunity maybe to blend everything together, put everything together if it's too difficult. The other thing that I know that happened during COVID is they were very difficult to get vehicles, so people were getting a premium on the vehicles. I think those premiums are gone now, so that's probably what they're facing right now, is that's why there's a loss to break those car agreements now. But you know, I think if the renewal is coming up soon, and even if you can't make it to your renewal, the penalty to break the mortgage now would be probably not as bad. So you might want to do it earlier rather than later, if you have to.
Right, and when you say break the mortgage, break the mortgage and refinance?
Yeah,
is
refinance and get the car agreements in there.
And bring it
take
all
the
in.
equity and then maybe pay. You can prepay a lease, and a lot of people don't know that if you've got a car lease, you can actually prepay it. So if you've got another 30 months left on it, and it's $700 a month, that's $21,000. You can actually give the car lease company $21,000, and now you've got the lease for the next 30 months where you don't have a car payment, and you just add it to your mortgage, so you prepay it.
Got it. Okay. Third question. I was lucky enough to buy my first home in 2016, and it has appreciated tremendously. I was thinking of converting this one to an investment property and buying my second home with my fiance. Can we buy it with 5% down payment since I'm no longer a first-time home buyer? Great
question. A lot of people think that you can only buy your first home with 5% down, and the truth is you can buy multiple homes with 5% down as long as they're owner occupied. So in this scenario, you've got an individual who purchased their first home, has lived in it. They're right, they built up some good equity. They may want to pull some of the equity out and maybe put 20% down, but again, because he owns this one on his own and then he's got a fiance for the next one, they might want to keep those ones separate. So you'll probably also be able to cash flow the investment property the way it is now, because the mortgage amount is probably lower and the rent is probably decent. So good idea to do it, but you can buy with 5% down. You don't have to be a first-time home buyer to buy with 5% down.
Okay, you don't have to be. Okay, got it. Frank, always a pleasure chatting with you. Thank you so much for your time. Frank Napolitano from Mortgage Brokers Ottawa.
Thank you so much, and please continue to support local businesses and charities.